Well, tell us a little bit about what was your path in the risk biz, and how did you connect those dots? I mean, there's probably a lot of our listeners or students that are maybe finance majors and may not fully appreciate how risk and finance and some of these other areas kind of all collide. And sometimes we stumble into this in our careers, and sometimes it's a little bit more thoughtful. So tell us a little bit about your path.
When I graduated from Iowa, I went into banking. And so I was a banker for about 13 years. And back then, as a banker, you were sort of a combination of a salesperson that is selling the services of the bank to clients, corporate clients. But you were also a credit officer where you would underwrite and provide lines of credit or loans to companies. And the last 4 or 5 years I was a banker to the insurance industry. And that's how I got connected with the insurance industry. But I would say as a credit specialist providing loans to large companies, the concept of underwriting and underwriting the risk and properly pricing the risk associated with a loan was sort of that first spawning of interest in the notion of risk management and sort of built some core early skills. But I then ended up joining one of my customers, Lincoln Financial Group, as their treasurer, which is really just moving to the other side of the desk. And so did that. But interestingly, one of the components of the job, which I ended up liking the most, was I was in charge of the rating agency relationships. And so that got me deeply connected to Moody's, S&P, AM Best, and Fitch, the four primary rating agencies in our industry, and what they analytically looked at and needed from a company in order to rate your company. And as you know, Jim, and maybe our listeners are less familiar with, but in the life insurance industry particularly, your ratings are essential to your franchise. We tend to think of having good ratings as being able to raise capital efficiently and effectively and cheaply. And that's all true. And it's true for the insurance industry. But the insurance industry is different in that we have both senior debt ratings and then we have what's called financial strength ratings, which are really actually a rating that's placed literally on the policies you sell to individuals. Because life insurance companies are in the business of making long-term promises. Obviously, death benefit for a life insurance policy, and then a stream of income if you're an annuity holder. Those are long-term promises. And so it stands to reason that if you're a customer or an agent selling a policy to a customer, you would want to steer people towards the higher rated companies. And so ratings are critical. If your ratings fall apart as a life insurance company, you are going to hurt your franchise considerably. And then insurance companies started to distribute through other institutions. Those firms only wanted to do business with insurance companies that had high ratings. And so if we were going to distribute our annuities through Merrill Lynch or Morgan Stanley, you would have to go through a process of working with Morgan Stanley and Merrill Lynch to assure them that the quality of your company is such that their financial advisors could represent your products to them.